Hello, everyone, and welcome back to the Trading Table. This is Andrew, joined with me is Landon, and today we're going to be going over some of the best ETFs to invest in at the moment. Okay, these ETFs are yielding insane returns right now, and the market is just climbing and climbing. So you should really be building your long-term investment portfolio right now, and ETFs are a great option, and we're going to tell you why. So an ETF is an exchange-traded fund. It's traded like a singular stock, but is commonly a makeup of many companies, or it's even like it tracks a whole industry, right? And most of the ones on this list, they do track like whole industries, but you'll see some examples of ones that, just have a makeup of not random, but not too related companies, right? So looking at our first one here, SMH, right? SMH is probably one of my favorite just because of, the semiconductor industry is just booming right now. I mean, that's probably the top industry in the world. NVIDIA is the largest weighted company, followed by, other tech companies. So great field all around. If we look at their holdings, we can see that most of their assets is in NVIDIA, right? And then, TSM, Avgo, the list is right here. And if we look at the year-to-date percentage return, right, all green, which is amazing. So SMH is doing really, really well. It's got, a 1-year performance of 74% to the upside and just one of the best ETFs on the market right now. Now, just like mutual funds, ETFs do have an expense ratio, right? So keep an eye out for that because sometimes it can get pretty hefty compared to the mutual funds. And you might be thinking, well, how is this different from a mutual fund? Why should I not just put my money in a mutual fund? So this actually tracks, more like companies, right? And also mutual funds are actively managed most of the time. I'd say 99% of mutual funds are actively managed. But ETFs are just, like regular stocks. You could trade them, whatever. They do have an expense ratio, but they have, the growth to back it up, right? While mutual funds might only get you like 12%, 15% at most, you got ETFs yielding, right, 74%. And, there's a little bit of risk that comes with that, but, if you can handle the risk and you can stay on the saddle, right, don't fall off, it's great returns.
Yeah, Andrew, an all around solid ETF, semiconductors to the moon. For now, at least, definitely don't play all your cards in one spot, but all around solid ETF. But moving on to our next one, we have the ticker symbol is IWF or iShares Russell 1000 Growth ETF. And basically, the main focus for this one is like, kind of like the broad market growth stocks, if you will, right? So like large cap growth category, in a sense, stocks like Microsoft, Nvidia, Apple, Amazon, Meta, all the big blue chip stocks, which is, kind of what you want just because, there's growth and there's always going to be growth because they just lead the market. You're basically, in a way, betting on the US economy, right? Because these are the, economic drivers for the United States. But this is suitable for people that, are kind of seeking like a long-term capital appreciation, if you will. But all around solid. Looking at some of their data now, though, they have an expense ratio of 0.19%. That's actually on the low side. So that's the plus for this. And then looking at, they have a 33 or 34% growth percentage for this year. That's actually really good. I know, it might seem a little underwhelming because we just looked at SMH, but, SMH is just blowing everything out of the water. So that's why this might look a little on the lower side. But trust me, 34% for an ETF, that's insane. But looking at their total assets, if we just scroll down a little bit, um, it looks like they have 60 billion in total assets, which is pretty good. But yeah, all around solid ETF.
Yeah, Landon. This one definitely moves a lot slower than others, as you can see here. It tracks, some of the slower moving stocks like Amazon, Meta, so forth, Apple. Nvidia is definitely a huge outlier, and it's definitely driving this pretty high but we do have a historic risk of average and an above average return. So IWF, great ETF. Looking at our next one though, we do have a Vanguard Value ETF. Now, Vanguard Value ETF is kind of an interesting one. If we look at the companies here, we can see that like it's very, very random, very, very, very random. And if we open this up more, so we could see every single one, right? We could see that Berkshire B, Avgo, J.P. Morgan. It's very like interestingly well-rounded, I guess you could say. You have consumers, you have multi-sector holdings, you have tech, household products. It's kind of interesting, but nevertheless, I don't really care about what's in it as long as it has good returns. And guess what? Definitely has the returns to back it. This is definitely ideal for value-focused investors aiming for just steady growth. This is what this ETF does, just steady, steady growth. If we look at the 5-year, right, we can see only up 46%, but it's just steady growth, right? It's growing. The risk is below average, so obviously no risk, no reward, but nevertheless, definitely a good one to throw in there, just to have a little bit less risk in your portfolio, right? And the common denominator with these holdings is that they're undervalued, right? Very, very undervalued, large cap stocks. So, the manager of this fund believes that, these are undervalued and they have the chance to go up a lot more. So we do have an expense ratio of 0.04, which is literally nothing. I'll literally sell you that myself if you're worried about that. But, VTV, great ETF.
Yeah, for sure, Andrew. And with the total asset of 168 billion, that's a really solid ETF there, just because there's so much money in there, and they have quite a lot of experience. But moving on to our next one, we have ticker symbol AVDV, or in other words, Avantis International Small Cap Value ETF. The name kind of basically explains what it is. It just focuses on international small cap value stocks, right? And looking at the 1 year, 13 or 14% growth, that's solid for an ETF. The risk is above average, so not my favorite, but this is really for just people that want to be diversified, right? And not put all their money into the US and kind of invest in like other economies that are recovering, right? So like recovering markets like India, Mexico, things like that. Um, but looking at some of their holdings, not super well known, but again, super diversified. Like the number one holding is only 1%. That's super low. So that's how you know that they're really diversified here. So that's why I like this ETF, because it's super safe, right? Um, and another thing is that if we look at their total assets, if we just scroll up here for a little bit, right? 6 billion, not a lot, but it's only been around open for 5 years. As you can see, the inception date is 9/24/2019. But 6 billion for 5 years isn't bad. Expense ratio of 36% or 0.36%. That's kind of on the higher side. So not my favorite, but at the end of the day, all around solid ETF, just because you're kind of investing in a different point of view, right? You're going for markets around the world that are recovering, which kind of gives you more potential for growth in like kind of a different way. But all around solid ETF.
Yeah, Landon, definitely better for those investors who think that the market could, come down and crash again, right? Because, if you're investing S&P 500 only and the market crashes, you're not going to have the best returns and you're not going to have the best time. So this one is kind of just betting against the odds, I guess. It's kind of like a safety net you could think of. Once again, like Landon said, the risk is above average and the return is average. So don't, put the whole account into this, but it's definitely good to have. Looking at our next one, though, we have XLK. I do really like XLK as well. If you look on the right here, we see the historic risk is below average and the return is above average. That is exactly what we want to see, and that's what we get with XLK. Now, XLK is a strong performance or strong performing ETF in a pivotal sector, suitable for people who want to capitalize on tech advancements and innovations. So looking at their holdings here, we can see very tech heavy, very, very tech heavy. Um, there's even some like not even just semiconductors. They just go dabble into the whole tech market. So they must really believe in the tech market here, right? Looking at the expense ratio as well, 0.09, right? So XLK is just such a good option. I mean, 33%, 0.09% expense ratio. The risk is below average. You really have nothing to lose with XLK. One of my favorites. They do have a total assets of 65 billion. It's pretty good. They've been around since the beginning of the market. Great ETF to invest in.
Yeah, for sure. Love XLK. One thing notable that I think everyone should take note is that they're actually moving around their holdings. I believe they're decreasing their holding percentage in Apple and actually increasing Nvidia, right? So they're basically doing like a flip flop. I believe it's going to be 22% Microsoft, 22% Nvidia, and then like 4% Apple, something like that. But that's a huge announcement for the technology sector. That's just something to take note. Won't really affect too much in terms of, you know, how much profit you get off this ETF. But I mean, it also shows that they're on it, hands on, and they see that Nvidia is growing like crazy. So it's time to invest more in Nvidia. But moving on to our next one, we have the ticker symbol is MTUM or iShares Momentum Factor ETF, right? And basically, the main focus for this one is U.S. stocks kind of showing a high momentum or high momentum characteristics, right? Um, Basically, the reasoning for this is like you're kind of riding market trends, right? So if like for instance, right now, SPY, the entire economy of the United States is moving really well upwards. So basically, it's hopping into stocks that are just moving up like crazy, like Nvidia, Broadcom, Meta, Amazon, JP Morgan, and so on, Netflix. But all around, solid ETF. I mean, if we look at the performance here, around 38%, 38% for this year, which is really good. If we look at the expense ratio, we just scroll down a little bit. Only expense ratio of 0.15%. It's not a lot. It's actually on the lower side. That's really good to see. Total assets of 10 billion. It's not bad. It's not amazing, but they've only been around for I would say 11 years at this point. So it's not too much experience, but all around solid way of investing. Just because if you're investing in high momentum stocks, I mean, you're only investing in stocks that are moving up forward. I mean, right? Like the risk is below average, the return is average, which isn't amazing to see, but it's good to see. Solid. That means you're gonna be making money, and all around good ETF.
Yeah, Landon, definitely, a more interesting one. Tracking momentum is definitely not easy. So, if you're interested in kind of being a little bit more risky, I know their historic risk is below average, but this one can be a little bit more risky as it does move a lot more. So if you're okay with seeing a little bit of red, then MTUM, great option. Go to our next one though, and I think you can see a trend with my favorite ones. It's always going to be tech, large growth tech. So if we scroll down to QQQ's holdings here, we can see Nvidia, Microsoft, Apple, the usual, right? Interesting one though, Costco. You know, very interesting in this list here, as we're kind of more like tech here, right? So Costco, an interesting, stock to throw in there. Expense ratio, 0.20%. They managed $270 billion. So QQQ, huge, 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 fund. This is a NASDAQ 100 index, so it's going to be mostly large cap technology stocks. And this does give the investor an opportunity to have exposure to the tech sector with a robust track record of performance, right? So if we look right here at the 5 year return, you got pretty crazy returns, as with anything in the tech sector. Just like all tech as well, you got an above average risk, but you do have a high historic return. QQQ, just an amazing option. I mean, it doesn't get really better than QQQ for ETFs.
For sure, Andrew. Definitely one of my favorite ETFs to actually day trade just because of the movement. Moving on to our next one, we have ticker symbol VBR, or the Vanguard Small Cap Value ETF, with a percentage for the year of 11 or 12%, more specifically 11.48%. The focus for this one, like the name suggests, is US small cap value stocks, right? So not, super commonly known stocks, and they're actually super diversified, right? So if we look at their biggest holdings, I mean 0.63%, that's so low that no single stock will move this ETF an insane amount, right? Uh, but basically, the reasoning for this one is it offers you kind of a mix of growth and value at the same time, right? So basically, it's ideal for investors looking for potential growth in small caps, stocks, and just a lot of value in that approach of this sort of small cap market. Um, but if we look at some of their data here, expense ratio of 0.07%, that's super low. Total assets of 54 billion, that's a really good amount. 20 years in experience, that's really good. If we go up a little bit, we could see that they have an above average historic return, which is really good to see. But in terms of risk, average. So that's not my favorite, but that's not terribly terrifying. Because average is all right, and as long as the return is better and you're willing to be a little risky, you will see profit.
Yeah, Landon. With these small cap ETFs, you kind of want to be careful. But if one does end up booming, it's gonna definitely affect the ETF as a whole, right? So looking at our next one, we now have DFIV, or Dimensional International Value ETF, and I think you can guess by the name that this is an international large and mid cap value stocks. So this one is more my favorite one for the international funds. If you ever want to, kind of invest in international funds, I'd go for this, right? So we got a top holding of Shell, and then just kind of diversified a lot around here, right? So this tracks international large cap, mid cap stocks. So definitely a lot safer than the one earlier, which tracks small cap international stocks. I definitely do favor this a lot more. Expense ratio of 0.27. It's been around, since close to the beginning of the market. 7.6 billion in assets. So, this is a pretty nice option, right? We have a yearly return of 9.91. This isn't year to date. The year to date return is 9.91, and this kind of just goes for those undervalued international companies. That's just for the investor that wants to diversify. You got a pretty matched return risk. So this one I would just hold as a safety net. Definitely don't dump everything into this. Definitely a good safety net to have with DFIV.
Yeah, for sure, Andrew. Definitely love that one. But moving on to which I think is one of our favorite and one of our most traded for this year, XLE, right? This one, if you guys don't already know, is an energy sector kind of ETF. Basically focusing on the U.S.'s energy sector, right? With the performance for the year of 14%, 15, definitely one of our favorites. And if you guys are in our Discord, you guys know, you know how high we are on this one. But overall, solid ETF. Um, in terms of holdings, we have Exxon, Chevron, all the big companies. Look at some of their data here in terms of expense ratio. An expense ratio of 0.09% is super low. Definitely love that. Total assets, 40 billion, and experience since 1998. That's really solid. a lot of experience there. Um, and if we go up a little bit, you could see that historic return of above average. That's really good to see. Historic risk is average. That's not terrible. All around solid. This is definitely one of me and Andrew's favorites. Um, but yeah,
Yeah, Landon. And the thing with XLE is, as a whole sector, energy is doing great this year. It's set to have a great year. So, I'm bullish on XLE, especially for this year. I picked up some shares when it was around like 89. So definitely recommend XLE to put into your portfolio. But, these ETFs offer a diverse range of exposure across sectors, market caps. You got some international ones. But, when considering ETFs, always take into account your own financial goals, your risk tolerance, and the current economic climate. This video is just kind of more just information. We're not saying, enter these on Monday. Do your own homework and, see what your risk tolerance is like. See what's going on in the news. Don't go into energy if you just found out that there's another deep water horizon and there's oil leaking in the ocean, right? So just keep an eye out and stay attent in the market. But that's all for today, guys. Thank you so much for tuning to the trading table. This has been Andrew and Landon. Please be sure to check out our free Discord. Link is in the description for any questions, concerns you might have about this. And we'll see you guys tomorrow for our weekly outlook.